The Investment Company Act of 1940 covers, you guessed it, investment companies. Okay, so investment companies are just packaged products. Remember I did the thing with the ADR? Well, it's sort of the same thing. Well, okay, let me just say, you guys know how an annuity works? How does that work with the investments? Anyone? It's daytime. It's a second day. You guys be yelling at me right now. We're all friends. An annuity is like a packaged product, right? You know that wraps around securities, and then your return is based on how the securities do versus your separate account does versus air. That makes sense? Yeah. Well, there's no benchmark in this one. So basically, a mutual fund is this. It's a shell, an empty shell, and you dump a bunch of securities in there. And then you maybe seal off the top or not. And then the value of the securities determines the value of the bottle. So this bottle right here is worthless. But if I fill it with gold or securities, the value of this bottle is determined by what's in it. We all good with that? That makes sense? So all of the things on the Investment Company Act of 40 are some version of that, where you're buying the shell, not the securities in it. And the value of the shell going up and down determines whether it goes up or down in price. The F is in, so FUM is the Investment Company Act of 40. It's FUN, sounds like fun, but it's not. FUM, Frank, Uncle Mary. FUM. So these are everything under the Act of 40. So first, F is face amount certificates. That's literally all you need to know. They're gone. They've been gone for a long time. They were actually kind of cool before, because obviously when you used to buy a house in the olden days, until the banks figured out how to eject every single penny out of it, what you do is you do an interest-only mortgage. You pay the interest for 30 years, but at the same time, you have to put money into this face amount certificate. So if you bought a $50,000 house, you would take out a $50,000, whatever the interest is, mortgage, and then you would buy a $50,000 face amount certificate. And you would put money in every single month toward that 50 grand. Like you put in 200 a month, blah, 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 all the way up. And it would be invested and grow. So maybe over the 30 years, you would put like 35 or 40 grand in, and the interest would complete the 50. So when your mortgage was done, you would get the certificate that says worth 50 grand and give it to the bank, and you'd be done. But the banks figured out they couldn't make as much money on that, so they got rid of that. Because imagine that, you could basically put as much equity as your interest in every month. So they got rid of that. So now they do the amortization schedule and the CMOs and all that, which we'll talk about. So that's one part of it. The second one is a UIT, which has kind of got what you got. Do you guys sell unit investment trusts?
No.
Okay. We actually do, because annuities are. Okay. Annuities fall under that. They're under that kind of thing. Where the hell did my oh, yes. So the U is UITs. Now, the participating one is the annuity, but a fixed UIT is basically has a fixed portfolio. Once they set it, they never change. So like with a mutual fund, an ETF, and a new variable annuities, if a bond gets cold or a stock goes away, they replace it with something else. Here, they do not. So they buy a fixed portfolio of bonds usually, and as the bonds get cold or mature, they do not replace them. So this thing self-liquidates. So it shrinks over time. Every time a bond gets cold or matures, the portfolio is that much smaller. When you buy it, you do buy it at NAV plus a sales charge. And the costs are very low. So it's almost like has a maturity date, pretty much, because the bonds will end. So the products have maturity dates. So we'll say that's a better one. Products. And I've seen that on a test, so I just want to make sure I get that. Product maturity date. And it's low fees because it's not managed. Remember, they're not doing anything. When I think of a UIT, the person managing it, I think they're sitting on a desk with a cigar and a beer, and they're just sitting there making sure nothing happens. They literally don't do anything. So the fees are low. And somebody usually buy these for income and they don't want a lot of risk. So risk averse, and they just want income and they don't want a lot of risk and low fees. That's it. Now on to the M. The M. Management companies. I need spell check, or you're really going to think I'm an idiot. Okay. Management companies. There's two types. Open end. Don't write the close end down. I'm just doing it here. Don't do that yet until we fill this stuff in. So open end is a mutual fund. So I'm going to erase this. I just want to make sure that you know that's one of them. Okay. Open end is a mutual fund. Now, let's talk about this. So a mutual fund, when you buy into a mutual fund, you pay the NAV plus sales charge. Now, when I think of this, I draw a little picture. You don't have to do this. I'm just doing it. Here's our fund. Say there's 20 grand in it right now. $20 worth of securities. I know that's. Yeah. Gillette, Tesla, Apple, Microsoft. All these securities are in there. Maybe some options, bonds, whatever. So that's in there. So now, as these securities go up and down in value, this will go up and down in value. That's fine. So that's what you want. You want this to go up and then this go up just by pure appreciation. But let's say we issued 20,000 shares. How much is each share worth, do we think? If the fund is worth 20 grand and there's 20,000 shares, what do we think the fund is worth? Each per share. Can we go with $1?
Yeah.
Good. $20,000 divided by 20 grand, it's $1. So that's the NAV. Now, let's say it's super cheap. It's fine. It would never be that low. That's like a money market, no way. But let's just do this one. And then when we buy that, we're going to pay a sales charge. Now, does anyone know what the max sales charge is? Why, yes, 8.5%. Awesome. Okay. So it's 8.5% sales charge. Now, it's a percentage of the POP, not the NAV. So it is not 8.5% of this. It's 8% of what they call the POP, which is what you pay. Now, I didn't think they did this, but somebody who took the test the other day said she saw this, so I have to address it. Now, there's a couple of things here. Now, I'm going to erase this, but no, I'm not going to erase this because I need to use it now. I'm going to put a line here so we have to. I'm going to keep using this. But let's say the NAV is $10 and the POP is $10.50. How much is the sales charge? Can anyone tell me? I'll give you a little hint. How much is the sales charge? 50 cents. Good. So the sales charge is 50 cents. Now the question is, they might ask you what the percentage is. Now remember, it's out of the 1050, not the 10, because it's out of the POP. So then you will then do 50 cents divided by 1050. 0.5 divided by 1. 5 divided by 1.5 equals 4.7%. So you might have to do this, okay? So 4.7% is my sales charge. Percentage. Do we see how to get that? So if they give you the POP and the NAV, it's subtract and then divide by the POP. Does anyone not get that? Okay. Now we're not done. Now let's say they're really cruel and the guy really was fighting with his spouse and really wants to get you. So let's say $10. Say the NAV is $10 and the sales charge is 4%. How would I get that? So this is what I do. So remember, it's 4% of the POP. So this is a crazy one. So what you have to do is you have to do 10, the NAV, divided by 100 minus the sales charge. So you're going to have to do 10 divided by 96%, which is 0.96. This might be the hardest math you have to do. So 10 divided by 0.96, 10 divided by 0.96 is 10.41. So my POP would be 10.41. Because remember, the 4% is not out of the NAV, it's out of the POP. Now, let's say you go, I don't get that, that makes no sense. There's a kind of a gamey way to do it. And it works almost all the time. Find out what 4% of 10 is. So that's 40 cents. And just pick the number that's the one that's higher than. It's going to be always a little bit higher. Because if you did 4% of 10, you would add that and you would get 1040. 1041's a little bit higher. So if you don't want to do it my way, which is not my way, it's just the way, and it just doesn't resonate with you, just figure out 4% of 10 and just pick the answer right above it. You're gonna be right 95%. Did I lose anyone on this one? Either you're too shy or you're really freaking smart, which is awesome. I'll assume you guys are super smart. Okay, so now.
Can you do an example of the other way?
Of what this again?
Yeah, but like with when
The 4% by the 10 and then the nearest number.
Sure. Okay, I'm trying to think.
Right.
Oh, hold on. I might have one. Hold on one second. Let's see. It's kind of a crazy question, but it does work, and it's going to look scary at first. This would be way more complicated, okay? But it works. Look at number 63. Can you all read it?
Yes.
Can you make it bigger, please?
See if I can.
Thank you
Is that better?
so much. Yeah.
Okay.
Yes.
Okay, everyone just read it. Don't worry about it too much. Just really read the last from here to down. This shit doesn't matter, but do it right from here. Okay, so we're working through this. So if I do $30, which is the NAV times 5%, I think that should be $1.50.
It is, yeah.
30 times. So then I would move my number to. So then that would give me 31.50 if I added it. Does that make sense?
Yes.
So then we know it can't be B, correct? Because that's the actual one. So go one higher. So it has to be that one. Because you don't do commissions on mutual funds out. You can accept the order, of course. So it's between these two. Like literally, I looked at it. Oh, 5%. Boom, that's 31.50. I knew it had to be that. Do you see what I mean by a little bit higher?
Yeah. Can you do it the right way too?
Sure. That's great. Now watch. Who said that? You're going to do it with me. Okay. So first I do 30 divided by what's 100 minus the sales charge? 0.95, right? Isn't the sales charge 5? Do 100 minus that. So you're going to do 30. It's really 95%, but that's decimalized into 0.95. Divided by 0.95, 31.57, which is 31.58.
Oh, okay.
Does that work?
Yeah, that does.
Yeah. It's really easy. It just looks freaking hard. And it looks so bad. They're like, oh my God, I can't do this. But yeah, it's not that bad. Did anyone not get how I did that? The one who asked me to do an example, does that help?
Where, how did you get
Yeah.
that point?
Oh, yeah, that was perfect, yes.
Oh, no, so, hold on. Somebody has to say that again.
Because I got on one of the first one, I got 3150, and then the second time, the second way, I got 3158.
Right. So if you did the 3150, you multiplied, you did 5% and then added it to the 30, right? And then the second one, you did 30 divided by 0.95 and you get the actual number. Because remember, if you do 5% of 30, the 5% of this 30, it's going to be wrong, but it's going to be one notch below the right answer.
Okay.
So that's what I'm saying. If you do it this way, you get this. It can, remember, the good thing is once you get this number, you know it can't be that. It has to be higher because it can't be that because this is 5% of the 30, which doesn't work because it has to be of the POP.
Okay.
So what you're saying is probably the safe way to do it is probably doing it with 30 divided by, and then that's 0.9.
Oh yeah, divided by 0.95. That's 100% the best way to do it. But what I'm saying is that if all of a sudden in a testing, like, I can't remember, well, you can always game it. Just remember the POP is the sales charge is a percentage of the POP, so it's always going to be a little bit higher than the sales charge of just the NAV. Does that make sense? I'm not a fan of tricks, but I am a fan of efficiency. And I'm like, okay, if they only give you one answer above it, why make it harder on yourself, right? Okay. Now, let's go back to our screen.
We got a question.
Sure.
What does POP stand for?
Public offering price.
Thank you.
And NAV stands for net asset value.
I got that one, but
Okay. No worries. Okay. So now let's go back to this again. So now we're going to play the game like it's not a, like there's no sales charge. I just want you to show that that's what that is. But we're going to say that the NAV, well, we'll do it this way. Well, it's 20,000 shares outstanding, and the NAV is $1. So if I'm going to buy, now remember, when you buy a mutual fund, you don't say I want to buy 1,000 shares. You say I want to buy $1,000 worth. So I'm going to buy $5,000 worth.
I have a question just real quick. I know you're going into that.
Yeah.
Is the NAV plus the sales charge equal to POP?
Yes,
Or-
it does.
Okay.
Okay. Okay, now, if I buy $5,000 worth of stock, now remember, I don't say shares because I don't know what I'm getting. Because here's the thing about the mutual fund, just like an annuity, they don't calculate it till 4 p.m. So if you buy at 10 in the morning and I buy at 2 in the afternoon, we're getting the same price. So remember that the rule is that when you put in an order for a mutual fund, you are getting the next calculated price, which is 4 p.m. They call that forward pricing. So that's why you can't say, oh, I want 4 shares or 50 shares. You don't know. And they give you fractionals. So if you put in 5,000 and it's not exactly $1, you may get like 4,992 and a half shares or like that. You will definitely get partial shares, and that's fine with them because they handle that. So in this case, I'm going to invest $5,000. And the NAV is $1. So that means I'm going to get how many shares?
5,000.
Easy stuff. So they're going to increase the fund because they print out new ones for me. So let's talk about that. So I buy shares from a mutual fund. They're going to create new shares for me. And if you remember from yesterday, creating new shares is an IPO. So you have to get a prospectus no later than settlement or completion of the trade. Same thing. Settlement and completion of the trade are the same thing. So you are going to get 5,000 shares, and since they're printing it out, making new shares for you, you need a prospectus, okay? You can get what they call a summary prospectus, which is like a meeting where they're just summarizing everything, as long as a paper one is available. Now, so once you buy this, you get the prospectus, and they're going to issue 5,000 new shares for you. So now the fund has 25,000 shares because it gets bigger when you go in bigger, and if you leave, it gets smaller. But then we also take your $5,000 and put it in here. Now I'm simplifying it, but this is the way it goes. So both the fund got more shares were issued and the fund got bigger. What's the NAV? Divide this by this.
$1.
Yep. So you buying or selling does not affect it. Remember that. Buying or selling mutual funds does not affect the NAV. The only thing that moves the NAV is the shares going up or down, or the shares going up or down, or them paying out a dividend. And that's the thing. Mutual funds have to pay out 90% of their income every year. So all their capital gains and dividends have to be paid out. And when they pay it out, it gets subtracted from the NAV because it's no longer there.
And what does NAV stand for?
Net asset value. It's literally what the fund is worth. It's like assets minus liability. Well, assets minus liabilities divided by number of shares. So it's really just the total value of the fund divided by the number of shares. Okay. Generally, is this okay for everyone?
Yes.
Okay. Sounds good. Okay. Now, if you sell them, say you decide you're going to sell your 5,000, they just do the opposite. They get rid of them, they destroy them. Again, and it's called redeeming, not selling. So when you give your fund, when you sell your shares or buy your shares, you're doing it to the fund or the sponsor. So they are creating shares or destroying them, but you're dealing with the fund or sponsor, not like a broker dealer. Okay, so that's a good start. Now now there's a couple of things that we have to go over. So now if you want to charge, remember what I said the max sales charge is?
8.5.
I love it. If you want to charge 8.5%, you have to offer certain things. One, breakpoints. Anyone know what a breakpoint is?
The discount for the buyer.
Why would they get a discount?
Volume.
Yes, volume, right? The more you buy, the less you pay. It's kind of like, okay, so we go to breakpoint. If you put in, say the breakpoint's at 20 grand. If you put in 10 grand, you pay 8.5%. If you put in 25 grand, you pay 7. So a breakpoint is a volume discount. So what's a breakpoint sale? So it's a violation, first of all. Do you know what it is?
When they don't give them the opportunity to put more in.
Yeah, perfect. Or they just don't even tell them that they could. Like if the breakpoint's at 20 grand and they put in 18, you have to say, hey, if you put another 2 grand in, you meet the breakpoint. The easiest way to handle it is to hand them the schedule and go, here's a breakpoint schedule, put in what you think. Okay. What if I have 15 grand and I go, oh, I'm going to get money over the next couple of months. Can you give me a discount now? Maybe. Do you know what that's called to get that?
Letter of intent?
Letter of intent. Exactly. Now, is it binding?
Yes.
Why? Why? No, it isn't. Not binding. It's binding on the company, but not on the individual. They last a max of 13 months. And you can backdate 3 months. 90 days, 3 months, right? So, but if you go back 90 days, then you can only go forward 10. It's 13 months. It's not 13 months from today. It's 13 months total. So if you backdate, it brings the maturity date further.
I got that question.
You got one? You got one of those?
Got that one.
Yep. Good. I'm glad. So now you know if you get it right, you get it again, you'll get it right again. Okay. So now it's not binding. So here's what happens. If you don't meet the letter of intent over that 13 months, basically what they do is the extra shares that you bought because you paid a lower sales charge, they disappear. So if you're going to pay 8% sales charge, you buy a certain number of shares. If you pay a 1% sales charge, you buy more shares. So those extra shares go into what they call an escrow or side pocket account. Then if you meet the letter of intent, you get them. If you don't, they just disappear. And it's like you paid the original sales charge. So nobody gets hurt on this. Letter of intent is always suitable. Now, one thing, you cannot meet the letter of intent through accumulation. You actually have to contribute the money. So you can't have a $20,000 breakpoint. You put in 18, fill out a letter of intent, and then just the value of the fund crosses 20. It doesn't matter. You got to put in $2,000 no matter what. Okay. Now this one's about to sound hypocritical to what I just said. Then they have rights of accumulation. But it's not quite the same thing. Rights of accumulation means if you put money in and it grows and it crosses a breakpoint, any new money gets the breakpoint. So let's say the breakpoint's 20 grand, you put in 18, and then when you go to put more money in, the actual value has risen to 21. So any new money you put in, that extra money you're putting in now, will be at the lower sales charge because you crossed the breakpoint. So the fact that your value of your fund crosses a breakpoint, that means from now on, not previous, now on, you get that breakpoint. And again, it works the other way too, in your favor, that if you start above a breakpoint and then drop below, they go with your contribution amount, not the total value. So getting over the breakpoint, once you're over the breakpoint, the only way you can get under is if you actually sell shares.
What's that last for?
The only way, if you put money into across a breakpoint, the only way to go back under it is if you actually sell the shares.
Oh.
The value dropping won't do that. And then the last thing is always nice. Reinvest at NAV, meaning no sales charge. So they will let you reinvest your dividends if you choose to automatically reinvest your dividends. Okay, if you choose to automatically reinvest your dividends, they will let you do it with no sales charge and capital gains. So this you get to put it in at NAV. But here's the thing. Here's the problem with it. The IRS goes, oh, but you got it. Even though you automatically reinvested it, we're still taxing your ass. So let's do it this way. If I have a mutual fund and I get a dividend or capital gains, and I go to say, you know what, press the button where I never see the money, it automatically goes back into the fund. The IRS goes, wait, we want to tax that. So in their mind, you got it and put it back in. Same thing with another thing a mutual fund lets you do is called, it's not switching so much, but you're moving from one fund to another inside of Fidelity. So if you guys, Fidelity's a family, Vanguard's a family, T. Rowe's a family, they're all separate families. If you stay in that family of fund, the actual mutual fund won't charge you a sales charge anymore. If you go from large cap to mid cap to small cap to speculative, all over the place, you can move as much as you want with no sales charge. But the IRS goes, if you sold it for more than you paid for it, you owe us taxes. So this is what I say about mutual funds. Everything about a mutual fund is taxable. Everything. There is nothing about a mutual fund that is not taxed, other than unrealized gains, like if the stock goes up on its own. But that's it. Anytime you get money, no matter what, in any way, shape, or form, it's probably taxable. Now, are you taking the 6 after this or the 7? Okay. The good thing is, what I'm doing now, if I'm going a little too deep, it sets you up for the 6, which is good. But it's better to understand the mutual fund. So when they ask you a question, it's not like, I'm trying to memorize. It's better to understand what's going on. So this way, if they can't twist it around. Because like you said, the wording gets you. But if you have a good enough knowledge, then the wording is not going to bother you. Okay. So now, if I go into a mutual fund, I want breakpoints, right? That makes sense. You want a volume discount. Only A shares. There's 3 different classes. There's A, B, C, and then a totally separate thing is a NOLA. Okay. Now, Class A, so if you think about it, when you went to school, the person who had the last number A was always in the front of the line when you were little. Okay, then it went to height and all that crap. So now, letter A is a front-end load. That means you pay a sales charge up front. When you enter the fund, you pay the sales charge. No, that's the only one that's eligible for break even. So A is front end load. It's you pay a sales charge when you go in, and you are eligible for rate points. So SC, sales charge when you enter. And you get break points.
Thank you.
And low 12B1 fees. Wait, Ken, you haven't talked about 12B1 fees. Does anyone know what a 12B1 fee is?
No.
Okay. So it's a marketing and advertising fee. So basically, a portion of your return is going to pay the marketing and advertising for this fund. And at first you think, wait a second, I'm paying them money as sales charge already. And then I have to pay every year, I have to pay a fee for marketing and advertising? Yes. Here's why. There's a thing called an expense ratio, what it costs to run the fund. And all of you are sharing that. Okay, so if I took the right half of the room and said, you guys all bought a mutual fund, and you're paying $1,000 a year for expenses. That's 1, 2, 3, 4, 5, 6. So that's 6 people over there. So you would divide that $1,000 by 6, and that's what you'd have to pay every year as an expense. But what if I said, what if I said, guys, pay me 50 cents a year, and I'll get the rest of the room to buy into it also. So then instead of dividing it between 6 people, you divide it between another, say a total of 12. So your actual portion of the fees goes down. So that's what a 12B1 fee is, marketing and advertising. I'm going to market to you. I'm going to advertise. I'm going to get you guys to come in and buy into this fund. So now all of you are sharing the cost versus just those 6. So that makes sense why we would do a 12B1 fee. It does help you. You're going to pay me 50 cents, and I'm going to save you $50 every year. That's the way it's supposed to work. It doesn't always work, but that's what it is. But Class A, you pay the sales charge up front. So you're paying the ongoing fees are going to be lower. The 12B1 fees are lower because they already got your money. Does anyone have any questions on just that part? Okay. Now, the people who would want to buy these are people who are investing for the long term and a lot of money. The long term because of the low, you paid your big fee when you go in, and the ongoing fees are low. But yet, since you put a lot of money in, you're break points. Then we have B shares. B shares for back end. That's like, they call it a CDSC, Contingent Deferred Sales Charge. Contingent Deferred Sales Charge. Now, that means every year you stay, it lowers the sales charge when you leave. So let's say you come in and you leave after a year, you pay 5%. After 2 years, 3. After 3 years, 1. After 4 years, half. And then after 5 years, you don't pay anything. So it diminishes the longer you stay. But there's no break points because there's no mechanism to do that because you're paying when you leave, and it's based on how long you stay. But the 12B1 fees would be like mid-size, a little higher. Mid-level, 12B1.
Yes, you did work.
Say that again?
We're good. Thank you so much.
Okay. So the mid-level 12B1 fees they're just, again, marketing and advertising. It's higher than these, but not really the highest. By the way, just so you know, the max is 1% a year. Okay. Now, C shares are not a no load, but there's no sales charge. You think, ooh, that's great, but you pay the max. You pay like the 1% 12B1 every year. So every year they call it like a level load. You're paying literally the same. You're paying 1% every year, 1% of your earnings every single year. So that's not good for long term because after like 5 or 6 years, it never ends. It's going to keep going. Now I'll explain. I have a fun analogy. Now the no load fund has no sales charge also, but the 12B1 fee can't be more than 0.25%. So you can have a 12B1 fee, but it can't be more than 0.25%. And just in case, that's the same as 25 basis points, if you hear that. 25 basis points means 0.25%. I heard, are we okay with this?
What is that? Can you explain the basis point?
So basis points just means, that's why I did a good video on this. So basis points is just a fancy way of saying percentages. So this is what I remember. 100 basis points equals 1% equals $10 on a bond. That works. So 100 basis points equals one. So on this, 100 basis points equals 1%. So what is 25 basis points equal? 0.25%. Does that make sense?
Yeah.
It's just slang that you use it. Like if you ever talk to traders, you go, oh, I earned 30 bips. It's 30 basis points. It's 0.3%. So I earned 300 basis points. Yeah, that sounds great, but it's really 3%. Okay.
Hold on, don't erase it.
Okay.
One more question. So you were saying that A shares are if you wanted to keep it a long run, and B.
And have a lot of money because it's break points. Because look at the ongoing fees are very low.
Okay.
And then you would think, oh, by the way, B is okay for long term also. It's just the fees are a little bit higher. Remember, the 12B1 fees are an annual fee.
If we own shares, how can we know if they're A or B? What are you saying?
They will tell you. When you buy them, look, 90% of stuff is going to be this or this. Okay? If you want to buy, like what happened is if you go, oh, I want to own it for a couple years, they'll go, okay, let's put you in C shares. Like it'll be listed on when you buy into it. Now keep in mind, these are 3 different ways into the same fund. Okay? So if you're in the large cap, Fidelity large cap fund, they'll say, oh, which way are we going? Are you going to be long term? Not long term with not a lot of money, or it's very short term. And they'll put you in. Either way, they're all into the same fund. It's just different entrances.
So 90% of the class shares are either going to be class A or no.
Yeah, they're almost all A because the fees are so low now. I mean, if you put somebody into a class A, there's no way anyone's charging 8.5%. And a lot of times, like if you guys do it through your pension plan or your 401k, there's a thing called iShares, which are made up for institutions. You can write that down too, just as a number. Just know that if it says iShares, that's so like pensions and 401ks can buy shares and they don't really pay a sales charge because people are going in and out all the time. And it's not fair to make them pay sales charges on their retirement. So this is my analogy. I think it's a fun. I'm going to open up a mutual fund. I'm going to open up a bar, a nightclub that it's done like a mutual fund. So class A is $100 cover charge, but the drinks are very small. The drinks are very cheap, not small, cheap. So if you're going to be in there for a long time, class A is the way to go, right? Because you pay the $100 up front and then you drink all night. However, we're going to say if you bring a bunch of your friends with you, we'll lower the cover charge. That's the break point. B shares, you pay nothing to go in, but for every hour you stay, we lower the cover charge when you leave by $20. But the drinks are more expensive. So that's good for long term, but there's no volume discount. C shares, no cover, but the drinks are $20 a pop. I call that the Tinder level, right? So you're going in there, you get one drink and then you leave. So A shares is for long term, a lot of money. B shares is for long term, but not really worried about money that much. And then C shares is in and out real quick. Okay. I think that club would work. Okay, so now, so that's kind of most of the mutual fund stuff, but let's go a little farther. Now, why do people buy mutual funds?
You get a lot of shares in not so much money.
Oh, so you can diversify, right? Right. So you're diversifying your portfolio. That's a big reason. What else? It's very liquid, super liquid. You will go in and out. You want out the same day. You will be out at the end of the day. But remember, the one problem is you have to wait till the end of the day to do it. You can place the order anytime you want, but you will not be out of it until 4 o'clock or so. So the first reason is diversification. Second reason is liquidity. And the third reason is professional management. You're paying for an investment advisor to actively manage it. Now remember, actively managed mutual funds they're trying to beat the market. That means you're going to be trading a lot, which means the fees are higher. Because they're trading, they're going to be creating commissions and fees. So all your expenses will be higher than if you bought a non-managed fund, like an ETF or something. So actively managed, you might have some alpha where they do better than expected, but you are paying a lot of fees for them. Okay. Secondly, there's also a thing called a closed-end fund. A closed-end fund is very similar to an open-end on the inside. However, see if I can do this. You can go back in time. So this is a closed-end fund. It looks just like this, but the number of, if we issue 20,000 shares, that's it. We don't sell anymore. So if you want to buy shares of this, you have to find someone willing to sell the shares on the market. It will trade on the exchange. So there'll be a market price. So let's say the NAV, let's make this 250,000. We'll say still 25,000. That will mean our NAV will be $10. Let's say it's $10 a share. It doesn't matter, okay? It doesn't trade at the NAV. It trades at the market price. So it could be like the bid offer could be like, you know, 950 by 1025. It may trade around it. It could trade above or below, but you're going to be buying it in the market and you're going to buy it at whatever price. So like there's trying to, so people are offering it at 1025. If you want to buy it right now, that's the price you have to pay. But if you own shares and you want to sell it, you might have to sell it at 950. So the whole point of this, it trades on the market. Now remember, a mutual fund, you buy at 10 in the morning, I buy at 2 in the afternoon, we get the same price. On a closed-end fund, it trades in the market. So if you buy at 10 in the morning and I buy at 2 in the afternoon, we'll most likely get different prices. And you can buy it on margin, you can sell it short, you can trade it just like a stock. That's a closed-end fund. Internally, it's the same, the active management, you have somebody managing the money, but outside of it, when you want to buy shares of it, they have a set number of shares, one-time issuance, and then they don't issue anymore. Now, they can issue more if they want, but treat it like a stock. So one-time issuance, you buy it in the market, all that stuff. That's a closed-end fund.
9.50.
Yeah, I'm just making up numbers. That would be like $9.50 by 1025. So if you wanted to sell it, you'd have to sell it at $9.50. If you want to buy it, you have to buy it at 1025. We will get to that. The whole bid-ask stuff. I'm just saying that it trades in the market based on supply and demand. That may be the word you use too. It's based on supply and demand.
So this closed-ended fund will be higher than the open-ended because it's managed?
No, it could be anything. It could be lower. I mean, what if the manager sucks, right? So it literally could be based on anything. Like, and the one good thing about a closed-end fund is that let's say you're in a fund, open-end fund and a closed-end fund, and the market's up, and all of a sudden bad news comes out and it starts dropping. Well, in the open-end fund, you can place the order, but it's not going to execute until 4. So that a lot of shit can happen in 4 hours. Where the closed-end fund, get out of it right now, and then it doesn't matter. So sometimes a closed-end fund or the ETF in a way are better because you can react. You can get out of it in the middle of the day. Does that make sense? So literally it's still this, but when you want to buy it, it's going to be traded in the market. So if you say the right side of you all bought closed-end funds and the people on the left wanted to buy them, you'd have to negotiate with the people on the right side of the room to come up with a price. Because it's like, just like if you want to buy Tesla or IBM or NVIDIA, you have to buy it at the price that it's trading at. That's what a closed-end fund does. So remember, an open-end fund, you buy an NAV plus a sales charge. Closed-end fund, there is an NAV, but it doesn't matter. You buy it at whatever the price is. Okay. I hear noises outside. People are leaving. Okay, so now, is that okay with so far? And again, open-end and closed-end are both highly managed, like they're actively managed. Now, they could do what they call an index fund, An index fund is a mutual fund, but it tracks an index. It's not active. It's literally they just go, whatever the S&P 500 is, we're going to buy the same percentages in our fund, and we're going to let it roll. Whatever the index does, we're going to do. We're not actively managing it. So that's anytime you have something that's not actively managed, the fees are less. Okay? So if it's not actively managed, the fees are going to be lower. So they made a thing called an ETF, which is just like it's actually an open end, but it acts like a closed end. It's a packaged product, but you can have you can have a little bit better time with it because you see what's in it. You can see like the percentages, whatever's supposed to be in the ETF, you can see the percentage that they're supposed to have of that stock. We're open and closed end, you can see our top 5 positions, but that's it. ETF, you see everything down to 0. Now, say it again.
You say the ETF is the index fund?
No, the index fund is just a type of mutual fund that is passively managed. An ETF is a totally separate product. Maybe I didn't make that clear. An ETF is a totally separate product. It is not actively managed. It is very transparent, and it trades on an exchange. Now, the thing about this is you can buy it on margin and sell it short, just like a closed-end fund. The thing about ETFs is since they're transparent, they also have, and let me go back to this. So since they have certain percentages, what they do is they just rebalance it every quarter. So every quarter they rebalance the portfolio. Because remember, say they're supposed to be like 2% this, 2% that, 2% this. And if one of those stocks bangs out and goes crazy, up high, or another one goes low, those percentages will be skewed. So they have to bring it back to it. So if the stock goes up a lot, they'll have to sell some of the shares to bring it back to being 2%. Like I don't have a big portfolio, but I have a portfolio. And about 3 months ago, I started buying NVIDIA, maybe 6 months ago. And it was about 3% of my portfolio. But now NVIDIA has gone up so much, it's actually 12% of my portfolio. So in reality, if I didn't love NVIDIA so much, I would sell some of it to rebalance it. And that's what ETFs do. They don't care. If they have 3% NVIDIA and it goes up to 10 because it grew, they will sell part of the position to bring it back down to 3%. That's the only trading ETFs do. Now, what's cool about ETFs is they're very liquid. You can be pretty narrow. They can be like a narrow-based ETF where it's just covering like disruptors or high tech, or it can be broad-based like the S&P 500. So they can do a sector, they can do broad. They can also do inverse, which is the opposite, which is kind of interesting and risky. Like literally, you can buy an inverse S&P 500. So if you think over the next 2 months the market's going to crash and go down, you could buy inverse ETFs that as the market goes down, your ETF will go up. It's like literally buying the opposite. They also have leverage, which means like, let's say I have a regular ETF and say I have a 2x leverage ETF. If the market goes up 10%, we'll go up 20. Market goes down 10%, we'll go down 20. Okay, so we have regular ETFs, which are moved with the market, and they're great for long-term investing. We have inverse, which move opposite of the market. Then we have leverage, which move more than. That makes sense? Okay. That's most of the investment company up to 40. That's where we are. I mean, you should be reading still, but that covers a lot of it. Any questions on that stuff? Okay. Good. Now, since we brought up markets and stuff, we'll talk about it. So I'm going to start with this. So the inside market is what people buy and sell. They place limit orders, which are just we'll get to. But the point is, there are things people called market makers. These are different firms. We'll say like New York Life. Let's say they're trading Tesla. So let's say New York Life is willing to buy stock at 10 and sell at 10.30. Then we'll say Bank of America, BOFA, is willing to buy at 10.05 but is willing to sell at 1045. So these are they call market makers, okay? Market makers are firms that will buy and sell all day long. So Goldman, GSCO. Maybe they're willing to buy at 950 and sell at 10.29. We'll say JP Morgan and Co. willing to buy at 975 and sell at 10. Okay. So these are all, so the left side is where they're willing to buy. That's the bid. That's the ask. So I always think badass. Bid. And ask. So all these people are bidding, they're competing with each other, right? So they're saying, I'm willing to buy. Here's what we're willing to pay. Here's what we're willing to sell. So as a market, you have to find the best prices. So you have to find the highest price anyone's willing to buy, which seems to be this one. And then the lowest price anyone's willing to sell, which seems to be this one. So the inside market right now is 1005 by 1029. So the best bid is 1005. And the best offer is 1029. So if I'm just a regular customer and I wanted to buy stock, what price do I have to pay to be guaranteed to get my shares? $10.29. Do we agree on that? Here's why. Right now, if you wanted to buy stock at 10.05, is there anyone on this list willing to sell it at 10.05? No, or it wouldn't be sitting there. Are they willing to sell it at 10.10? No. Are they willing to sell it at 10.20? No. Are they willing to sell it at 10.29? Yes. Goldman Sachs says, I'll sell 100 shares at 10.29. That means they're willing to sell 100 shares at 10.29. Could they go lower? Sure, but right now the answer is no. You could change your mind, but this is a snapshot in history right now. So the highest price bidding is 10.05. The lowest price offering is 10.29. So if I want to sell stock, I have to sell it where people are willing to buy it, which is 10.05. And if I want to buy stock, I have to buy it where people want to sell it, which is 10.29. Now, that's great, but New York Life is going, wait a second, I don't like being second fiddle. So they go, you know what, you're willing to pay 10.05, that's fine. I'm going to change it. I'm going to bid 10.06. So that means this inside market goes to 10.06. So now the inside market is 10.06 by 10.29. So if somebody's willing to sell it, they'll be able to sell it at 10.06 versus 10.05. Now, let's say somebody comes in to sell the stock at 10.06 and they hit your bid. You're no longer there. So then you're going to change to another price. Maybe you just want to have anything for a second. And the best bid goes back to 10.05. That's a constantly changing market all day long. People buy, people sell. Prices change, markets change all the time. There's an artist that she liked, and trust me, it sounds like I'm sounding foofier than not. It's not that expensive. She draws like whales. Okay, so now then flowers. So my wife really likes this artist. So we went up to Massachusetts, went to this flea market. There's another one in 2 weeks. Okay, and she really wanted to buy the painting. And I said, okay. And she goes, wait a second, you're not negotiating. And sometimes I do, sometimes I don't. Sometimes I'm in the mood to have fun, and sometimes I aren't. But she said, you're going to in there, and whatever price she asks, you're going to pay it. Because it's not expensive. I mean, you're talking maybe a couple $100. So it's not like it's walking in like I'm bidding like with a card for $1 million. She goes, whatever she wants, you are not going to negotiate. You're not going to piss her off. Okay? So I said, fine. So I walked in there, and she said, I like this painting. So it was like $250. So I said, fine, I'll buy it. Okay? So that was fine. That's a market order. That means I'm going to buy it where people are willing to sell it. So if we go back to this, a market order is you pay the price that's being offered. So this is the equivalent. So the best offer right here is at 10.29. So if I do a market order, I have to pay that price. And I did, and it's fine. Happy wife, happy life. It's a 5-hour drive. I don't need to miss out on a painting just because I want to save 20 bucks. Now, that's a market order. Now, if she was trying to get rid of her paintings, and there's a buyer that said, "Oh, I'll buy them for 200," she would sell those paintings to whoever it was at the market order. So a market order means I don't care about price. Did I do the shoe story, the shoe breaking story about market order? Did I talk about limit orders or market orders at all? Okay. So this one resonates too. If you're on the way to an event, like a dance or something like that, and your shoe breaks on the way, but you happen to be next to a Nordstrom's, you're going to walk in there and you're just going to buy the shoes, whatever they freaking cost.
Yeah.
I just need shoes. That's a market order. Just boom. Does that make sense? That makes. Now, let's say you have weeks to prepare and you go, look, I'm buying shoes, but I'm not an idiot. I'm going to max out. I'm going to pay $80 for them. And if they come in, that's a limit order that's saying I'm willing to pay $80 for shoes. If the shoes are $85, are you buying them? Well, emotionally, yes. But according to my rules, no. Because you're saying I'm willing to buy it at 80, and if they're 85, I don't buy them. You're setting a budget, a limit, okay? So a limit order is, hey, I'm willing to pay 80 for these things, but if somebody can sell some to at 85, you go, I'm sorry, I'm not willing to pay that. But remember, if you get in there and you're willing to pay 80, and the shoes are offered at 75, you're sure as hell buying them because they're within your budget. Does that make sense? Mm-hmm. So that's kind of the way limit orders, market orders are, I just want to buy or sell it. I don't care about price. It's about speed. Okay. A limit order is like, hey, I want to buy it or sell it, but I don't want to spend a crazy price. So again, back to the flea market. As we're leaving, there were some chairs. My daughter just moved into the house, and we want to buy, get chairs for her or whatever. So we saw like 5 or 6 chairs, and the guy was offering them at $150. She said, fine, you can negotiate. So the person offered him at $150. That's the ask. I said, I'm willing to pay $120. And that's the bid. Okay, that's the bid of $120, the ask at $150. So right now, if he wants to sell the shares, he has to hit my bid at $120. If I want to buy the chairs, I have to pay $150. So we're standing there staring at each other. He goes, fine, I'll do $145. And I go, fine, I'll do $125. Now the bid is $125, the ask is $145. So this makes sense how the market is. That's literally how it goes. But now some bastard walks in and goes, I'll pay $140 for the chairs. Oh. So that's a new bidder. So now I'm no longer on the top bid. So now the best market is $140 by $145. You see how it got tighter up? And that's what happens on the stock exchange. The bid changes all the time. So then my wife looks at me and I go, fine, I changed my order to a market order and I bought the shares at $145. So he bid $140, beat my bid, so I'm no longer the best bid. The guy doesn't care about me anymore because there's someone willing to pay more. So I go, fine, I'll pay $145 because I didn't want that other person to take that bid or that seller to sell it to the person at $140. So that's how the markets work. It's literally a bid and an ask, and you work your way through it. Now I'm going to go into literally slobs over bliss, which everyone always freaks out of. Okay, so now, does everyone get market orders and limit orders now? Does that make sense? Put it in real world? Okay. So have some fun at the next flea market. Okay, so now. So before I do that, I have to get into, do we know what shorting stock is? Did we talk about that yesterday? No. I don't think so. So, well, I think I might have talked. Oh, I did talk about it. I did it when I did Acta 34, right? So what is short selling? Can anyone tell me?
When you bid that is going down.
How do I do that? So you borrow shares and then sell them at that price and hope they go down lower so you can buy them back at a cheaper price. Does that make sense? Okay, but here, let's go into the risk now. I have to make sure we're on that. Okay, now. Let's say you own 100 shares of Tesla at 40. You'd be a happy person. You own 100 shares of Tesla at 40. What do we want to happen?
Would go up.
Yeah, I agree. So then maybe what I'll do is I'll go, you know what? If it goes to 45, just sell it. I'll make some money. So you go sell 100 at 45. That's a sell limit order, okay? That's a sell limit. You're doing it to take a profit. We all good with that? I don't need it to trade there once to happen. Literally, I'm saying, hey, I'll sell stock at 45. If anyone wants to buy it from me, I will sell it to them. I don't need a trigger. I don't need anything. I'm willing to sell it at 45. However, what am I afraid is going to happen?
The price is gonna go up.
Then I'm afraid it's going to go down. So look, I've done my math and I go, look, if it drops to 35, it's far enough down that I don't want to be involved. So I'm going to sell 100 at 35. Stop. That means, I call it stopping the bleeding. That means it's going to limit my loss, hopefully to around $5. So no guarantee, but it's there. So I'm going to watch it. And the order will not, no one knows the order's there at all, other than you, me, and the system, until it triggers. So a stop order needs a trigger price and then an execution. So now the thing about a sell stop is that it triggers at 35 and then it'll be the next price no matter what. No matter what. Once it trades at 35, boom, it's turned on and it becomes a market order. Kind of like if I called up Dan and said, hey, listen, I'm long stock at 40. Can you do me a favor? If it sells at 35, just dump the shares and get me out of it. I don't want to be part of this. So he watches it every day, and once it trades at 35, he'll sell the shares. Or he could just be smart and just place an order to sell 100 at 35, and it does it for him. So what happens is, stock's trading at 36, nothing happens. Truck's at 35.5, still nothing. Stock trades at 35, boom, that's the trigger price, and then wherever it trades after, we sell it. So it triggers at 35, and then wherever it trades after, we don't. It will absolutely sell in the next price no matter what. And normally that's within a penny or two. It doesn't have to be. It could be at $0, $2. It could be at $100. But it's whatever the next price is, no matter what the price, it's going to sell it at that price. Did it make sense so far? So its stop order is this, and it's called the contingent order because it doesn't get executed until something happens, like stock dropping to 35. Okay. Now, and it works. Now we got selling at 135, stop. Once it triggers, it becomes a market order. Even if the next trade was $2, it would sell it. But that's a risk for me. So maybe I don't want to do that. So I'll make, instead of a sell stop, I'll do a sell stop limit. A sell stop limit means that if it triggers at 35, it becomes a limit order, which means I won't sell it at the next price. I will sell it at the next price at 35 above. So it just becomes a limit order. So a stop order and a sell stop and a sell stop limit are literally the same thing except for the end result. A sell stop, once it trades at 35, whatever their next price is, we're going to do it. A sell stop limit, once it trades at 35, it becomes a limit order and I will sell it at 35. Okay. So I'm using, remember, so stops protect, limits do not. I'm doing this to protect, this I'm doing this to take a profit. However, let's try a new scenario. Let's leave everything up there. I'm short 100 shares of Tesla at 40. I want it to go down. So maybe I'd place a buy limit below. Buy 100 at 35. A buy limit. No stop, no nothing. I don't need it to trigger there. I just want to buy it. That means if it trades there, I'm willing to buy it. Okay, now, what am I worried about? I'm worried that the price will rise. So I'll say, okay, I'm worried it's going up. Because remember, if I short it at 40, if it goes up, I have to buy it back at a price higher than I sold it for, and it's going to cost me some money. So I'm going to say, listen, I'm willing to lose $4 or $5, but not a lot. So I'm going to do buy 100 at 45, stop. By 100 at 45, stop. That means as long as it's trading below 45, no one knows the order's there. But once it trades at 45, it's going to trigger, and I'm going to buy it at the next price no matter what. That's a buy stop. Stopping the losses. The whole point is that it's not guaranteed to stop the losses, but 90% of the time, it's going to trade within a penny or two of 45, and I get out of my position. The whole point here is to stop the bleeding. You're short, it's going up, just get me out of it. If you're long and it's going down, I don't know, just get me out of it. Now, the way I look at everything is sell limit up here, buy stop up here. So it's sell limits and buy stops. Then buy 100, then buy limit, sell stop. So you remember slobs over bliss. That just means slobs, sell limits and buy stops are placed above the market. Above the market. So if you see, oh, you want to buy it above, it has to be this, or sell it above, it has to be this. If they say you want to buy it below the price, it has to be this. If it says you want to sell it below the price, it has to be this. And remember, stops protect, limits do not. These two are for long positions. These two are for short positions. So let me find a couple questions. I don't think we did this already. Did I lose anyone in that one? I lost you? You're shaking your head lost, or you're shaking your head got it? You don't have it.
Lost.
Don't have it.
Then you got to stop me. Okay. Okay. So, which part did I lose? Everything or just part of it?
I think the part we're talking about long and short.
Okay. So you mean with long stock versus short stock? Okay. Do you know what long means? Long means own. Long means hold. Long means you buy. Buy, own, hold, long, all mean the same thing. So if you buy stock or you're long stock, what do you want to happen?
You want it to
You
go
agree?
up.
Does everyone agree you want it to go up?
Yeah.
So then maybe I'd sell stock above where I bought it to take a profit. Does that make sense? So if I bought stock at 50, if I did a sell limit at 55 and it executed, I would make $5, correct? So I do it to me. So what am I worried about when I own stock? I want it to go up. Where am I afraid it's going to go down to? To zero. So maybe I'll say, listen, I bought it at 50. If it goes to 45, I'm okay losing $5. I don't want to lose more than that. So if I do a sell stop, that means once it gets to 45, I'm going to sell it. Not before that. It's literally just saying, hey, watch my order. If it trades at 45, I've lost enough money. I don't want to lose any more. Just sell it at the market. Does that make sense in a way?
I think so.
Do you think so? So walk me through it. So if I'm long stock at 50, what am I afraid is going to happen?
I'm just trying to think of an analogy that I can like understand.
With the analogy for the long part?
I'm just
Okay.
trying to like renting a house versus owning a house.
Okay.
Like that's where my brain's going.
Okay. So long is owning a house. Don't think about renting though. Long means you own the house. What do you want to happen when you own a house?
I want the equity to increase.
Yes. Well, you want the price to go up, right? Don't make it harder. You want the price to go up. Because the equity won't go down unless you borrow from it, right? So what are you worried is going to happen in the next, like what happens if we have a housing crisis in the next 6 months? What are you worried is going to happen?
It's not going to be a value depreciation. Yeah, it's going to depreciate.
Right. So what if, say you pay $200,000 for your house, okay? And you go, it goes up to 300 grand, you're happy, that's awesome. And then you go, wait a second, the interest rates are dropping, job losses are bigger than we thought, the market's going to be bad. I was going to say something funny about politics, but I won't, because I'll piss half the people in the room off, and then they have to be like, yeah. So if the price drops, okay, if the price drops, you're like, crap. So what if you say it's at 300 now, but you tell your realtor, look, if you see that the price of my house would drop to 275, sell it. I want to take a profit. I'll find somewhere to live. Does that make sense?
On it.
Like, that's not perfect because you're not going to move out of your house. But if you tell the realtor, listen, sell it once. If you see that the market price is only 275, find me a buyer. I'll just sell it. That's what we're doing. The short one's harder. It's almost like, oh, say you don't own yet. You're going to buy a house. And you love the house you're looking at, but you're not ready to pay. You're not really ready to buy it. So you don't really own the house. You're kind of short a house right now. You're living in a cardboard box, okay? and you want to, at some point you want to buy a house, but you don't want to pay too much yet. So you're technically not owning the house yet, right? But you love this development. What if you see prices going up? That would be bad, right? So you tell your realtor, listen, the houses are going for 200 grand. I'm not sure I want to pay that, but I'm afraid of paying more. So if you see the prices going to 225, just buy me a house because I think they're going to go to 300. I don't want to pay 300. Does that make sense?
Yeah.
So now the other thing is you can say, listen, the houses are 200. I'm going to say, I'm going to bid you 150. In case the house prices come down, I'll get to buy it on the cheap. So understand, long means you own it, short means you don't. So if you're short, you're worried about the prices going up. So you do a buy stop in case they go up, or a buy limit in case they go down. Does that help a little bit more? So now let's change it to stock. If you own shares of Tesla, okay, you own shares of Tesla. You love Tesla. Elon Musk is the greatest guy in the world. He's moving to Texas. He's going to save all in the income tax. What's going to happen to the price of his stock?
No.
Of course it is. You go to Texas, it goes bigger, right? So it goes up. It's going to go to, it's at $40 an hour. It's going to go to 60, 70, 80. But you want to just sell it. So you just say, listen, if it gets $70, I'll take a profit and I'll make $30 on it. So you sell limit. Does that make sense?
Yeah.
But you're worried that all of a sudden he's going to move to Austin. No, I'm kidding. And he's going to move to, and it's going to go, I'm just totally fucking around. I promise you that. Okay. So now it goes, and it's just horrible. And it goes down. Wouldn't you want to get out of it at a fair price?
Yeah.
So you say, listen, you tell your broker, look, I bought it at 50. If it gets down to like 45, I'm losing money on this. I own it at 45. I own it at 40, 50. I mean, it goes down to 45. I'm down $5. Does that make sense? If you buy it at 50 and it goes to 45, you lose $5 unrealized. But you think if it gets to 45, you think it's going to go even lower and lower and lower. So you tell them, sell it at 45. Once it gets to 45, just sell the stupid thing. I don't want to be part of it anymore. I'll watch it then. So you say sell stop. Sell 100 shares at 45 stop. That tells your broker that as long as it's above 45, you're still good taking the risk. But once it's at 45, sell my stock so I don't own it anymore. And now I lost money, but I lost less than I would have. We okay with that in a way?
I completely understand.
Okay. But now let's talk about the short part. That's where it's going to get lost, but we're going to be fine. Do you understand what shorting is? Okay. Shorting is, let's say now I own Tesla shares. And you go, oh my God, the biggest mistake in the world. Elon Musk is an idiot. It's going to go to zero. So you go to me, Ken, can I borrow your shares? So I literally give you my shares to borrow. I'm lending them. You're paying me a little bit of money, but I'm giving you the shares. You are now holding. You don't own anything. You're holding 100 shares of Tesla, and you could sell it for $50 a share. You didn't do it yet, but does that make sense that you're borrowing my shares? Then you go out and sell my shares, you bastard, at $50. You're selling my shares. Does that make sense?
Yeah.
Okay. You're selling my shares at $50. And you now have $5,000 in your pocket by selling my stuff. That is so wrong, right? In real world, that's a felony. In our world, it's celebrated. So you now have $5,000 in your account from selling my shares. So if you're at some point, you have to give me my shares back. We okay with that? So you want the stock to drop to 40, so you can buy it back for 40, spend $4,000, give me my shares back, and how much would you make? $1,000, right? Does that make sense what I just said? I need a head nod.
Yes.
Okay, good. Okay, just making sure. So if you shorted at 50, you put a buy limit at 40. So if it goes to 40, you buy it back at 40. Yeah, I made $10 or $1,000. That's a buy limit. You're taking a profit. We should be good on that. Now, but remember, he's saying I don't want to pay more than 40 because I think it's going to 40. If it goes to 41 and stays there, you're not buying a thing. You have an unrealized gain. Here's the issue. Remember, you have to buy the shares back at some point to give them back to me. What if the stock goes to $60 a share? What are you going to have to do? When I go, hey, I want my shares back.
Go buy them back at 60.
Yes, you have to buy them back at 60. What did you sell them for? And you have to buy them back at 60. So how much are you losing? $10 or $1,000. Are we okay with that? I mean, not okay with it happening, but does that concept make sense? Okay. So instead, now here's the question: how high can stock go? Unlimited. So I have unlimited risk. So I'm really worried. Now this is the way I explained it. Do you ever hear of GameStop? Do you remember what happened with that? It was trading at $20, and Merrimack Capital just Meridian Capital just shorted millions of shares. And then the people on Reddit go, hey, you know what? That's crap. They bought it and bought it and bought it. So they pushed it up to 40, to 50, to 60, to 80. How high did it go? Does anyone remember how high it went? $600 a share. It might have tipped at 650 at one point, but it went to $600 a share. That means if you borrowed my shares and shorted them at 20, and then it went to 600, I go, hey, I want my shares back. You'd have to pay $600 a share to give them back to me. So that's crazy talk. So what I'll do is I'll do a buy stop. You short it at 50, you'll do a buy stop at 60 or even 55. It doesn't matter. You're saying I'm willing to lose some money, but once it gets up to 60, just buy it. I don't want to lose any more than $10, so I'm going to buy it back. So I do a buy stop at 60. That means as long as it's below 60, nothing happens. But once it trades at 60, it's going to trigger, and then I buy it at the market. And then it'll probably trade at like 61, 60 and a dime, whatever it is. But then I don't care. Once it goes up to 100, I'm out of it. Is that any better?
Yeah.
Okay. So again, if I'm long stock, meaning I own it, I do a sell limit or a sell stop to protect. If I'm short stock, I do a buy limit or a buy stop to protect. So remember, you're always doing the opposite of what you have. If you're long, you do selling things. If you're short, you do buying things. Now, here's a little thing I write down to remember. I'm glad you asked. It sounded like you weren't the only one confused, but you're all going to let me just roll on to the next thing. Okay, so now, you're here, baby. I'm here for you. Okay, so now, if I'm long stock, which means I own stock, I always make it like Russia. I don't know how to put a T in. I'm going to do, so you just have to write this down. To take income option-wise, I would sell a call. To protect, I would buy a put. Again, you don't have to do the math. You probably won't have to do much of the math. Now, if I want to take a profit, I do a sell limit, meaning it's above the price. If I want to protect myself, I do a sell stop. So if I'm long stock, which means I own it, I'm going to do a sell call for income, buy a put, or sell. These two are for protection. Buying a put or doing a sell stop. And if I'm long stock, I sell a call for income because I just get the premium. I do a sell limit.
You said buy put and sell stock for protection.
I do, yeah, bottom two are protection, right? And if I'm short, so I can even put that down here.
And what is the sell limit?
Sell limit is to take a profit. Like you buy stock at 30, you try to sell it at 40, you're taking a profit. So I call this, yeah, this is protect. And if I'm short stock, which means I don't know it, I would sell a put for income or do a buy limit to take it below, to take a profit. I do buy call for protection. Or buy stop protection. So these two are protect. Whenever you sell an option, it's for income. And limits are really just to either take a profit or establish a position. Again, this is probably more than you need to know, but it's good to have it anyway. Like, no, this is pretty as much as you need to know. Half of you won't see anything about the options on this, but if you do, you do. We're getting through it.
Sell limit and sell call for income, right?
Yeah, well, this is for income This is to take a profit. Remember, when you sell a call, does everyone have this written down?
1 second.
Okay. When you sell an option, what do you get in your pocket? Premium, right?
Yeah.
When you sell an option, you sell it for a certain amount, you get premium. Did we do options yet? We did basic, right? Okay. You don't need it deeper. I mean, you're going to get 3 or 4 questions max.
Do you have to pay a premium for the call or the?
When you buy an option, you pay the premium. So I get just understand. So don't write this in here, but I'm just putting it in here to throw it in there. When you sell a call, you get premium. I mean, you can put it in there, yes, but when you sell a call, you get premium. When you buy a put or buy an option, you pay the premium. Like you buy insurance, you don't sell it, okay? And then over here, let me put it inside. When you buy a call, you pay the premium. When you sell a put, you get the premium.
So if you need to sell the limit or the stock, is that a different premium?
You're not getting a premium. Remember, premium is for getting. You get premium because you're buying a call or selling a call. Limits and stops are just orders. They are orders. That's what I'm saying with sell limit. You're not doing it for income. You're doing it together. These things. Where is it? The buy limit. The buy limit. You're just buying it. You're not paying a premium. You're actually just buying the stock when it gets to a certain price.
Okay.
I really just do this so you know what goes with what. They're not all the same thing. I'm just saying they go with each other. Like if you're long stock, these are your choices. If you're short stock, these are your choices.
So in other words, kind of like when you pay the premium, you're protecting it by kind of like
Yeah.
insurance.
Right, because you have the right to do something, right? Yeah, so you remember you buy insurance. So look, when you get sell insurance, what are they paying you? Premium, right? And what are you guys getting?
Protection.
No. What are you guys getting? You're getting the premium, right? So think of options as like insurance, right? So if the customer buys the insurance, you're getting protection. If you're selling it, you're getting the income. You're not, I mean, why are you selling it? We're in a room here. Why are you selling insurance?
To protect.
Are you doing it to protect the person or to put some money in your pocket? Okay, fair. Okay, let's do it this way. Why is your, yeah, good answer. We're on recording. Why is New York Life selling insurance? To get money. That's what selling options does. You're literally doing it to make money. Yes, I'm sure somebody's like, oh, I want to help you out, but no, it's about me. They're strictly about profits, getting money. And that's nothing wrong with that. That's the purpose of it. So you buy insurance for protection, you sell insurance for income. So when you do an option, you buy an option for protection usually, and you sell it for income.
Okay,
And remember, and when you think about it, what is New York Life taking on for that money? They're taking on risk that all of a sudden everyone dies or something like that, or dies before they can recoup their money. That's what you're doing when you sell an option. You're hoping that it expires before you lose money, but the big risk is that something bad happens and you lose more than you got.
Okay, for selling a call, what is the max gain and what's the max loss?
Okay, hold on. The reason I'm writing that this for the 7, you don't need to be confused. Okay, so if I buy a call by itself, what's my max gain?
Premium.
What is it?
Premium.
When I buy a call, feel free to look at the chart. If I buy a call, what's my max gain? Unlimited, because the stock can go up to forever, okay? What's my max loss?
Premium.
Which disappeared. Where'd it go? There it is. Okay. So the most, remember, whenever you buy something, the most you can lose, right? Whenever you buy something, the most you can lose is what you spent. Whenever you sell something, go down here. Whenever you sell an option, the most you can make is what you got, the premium. So look, if I buy a call, my max gain is unlimited, my max loss is premium. If I sell a call, my max gain is premium, my max loss is unlimited. They're both two sides of the same coin. Now, if we jump over to the put side, if I buy a put, the most I can make is what they call break-even point, which is strike minus premium. The most I can lose is premium. If I sell a put, it's the exact opposite. The most I can make is premium. The most I can lose is break-even. Now, let's talk about this, since it seems like we're not all super cool on this. So now, if I buy one XYX 50 call at 3, what's my max gain? Use the chart. Somebody's got to be able to rip this out. What?
What was the question?
What's the max gain?
Limited.
Unlimited.
Good. What's my max loss?
Your premium.
Premium.
What number is that? 3 or 300, right? What's my break even?
53.
Good. Okay. What if I sell a call? What's my max gain? What's my max loss?
Unlimited.
Unlimited, right?
Yes.
What's my break even?
47.
No.
53.
53.
Yes. Call up, put down always. Strike plus premium. Okay. Now, buy one. Buy one XYX, October 50 put at 3. What's my max? You got to give me a number this time. What's my max? First of all, what's my max loss?
300.
3. What's my max gain? What's my break even on this?
53.
Hold on. Is it a call or a put?
Put.
Call up, put down. I'm glad we're doing this. Call up, put down. So it's a put, it's strike minus. What's my break even?
47.
So what's my max gain? 47. I'll show you why. And what's my max? So then what if I sell a put? Max gain is premium, max loss is 47. Do you guys have some version of this chart?
Yeah.
You're not using it though, right?
Still learning.
So, but that's what I'm saying. If we do this, so does everyone have some version of that chart?
Yeah.
Does everyone have some version of the chart right in front of them? Here's the thing, what everyone tries to do. They go, oh, I'm not going to use it when I do. Why would you not use it? Because you're going to write it down when you go take the test. So might as well get used to using it. So everyone either take a picture of it or write it down. So what we're going to do is we're going to do problems, but I want you to get this. I want you to get this chart. Everyone, I need to tell me when you're done getting this done ready. That was English, I know.
Oh, I got one.
Just make sure is everyone done writing it?
Yeah.
Okay. It's coming off the screen.
Thank you.
Okay. Now I'm going to challenge you a little. I buy a 30 put at 3. Now I'm going to show you how I do this stuff, so then you can see how easy. You don't even sometimes you're going to use the chart, but I'm going to show you how I figure stuff out because it's very easy, and then you can find the max gain, max loss within it. So I have 4 steps. So 1, break even. 2, bull bear. 3, strike price. 4, profit and loss. So can anyone tell me what the break even on buying a put at 3 is?
27.
Everyone agree that it's 27?
Yes.
Okay, that's my ground zero. That's my break even. That's where everything's 0. Am I bullish or bearish?
Bears.
So it means anything below 27 is a gain. Anything above 27 is a loss. Can we get the wrap our head around that? Because the break even is 0. The break even is our 0 number. That's where we make neither make nor lose money. So every point we move away from the break even, we're either making or losing a point or a dollar. So if we're bearish, that means anything below 27 is a gain. Anything above 27 is a loss. Because remember, break even is our ground zero. So if the stock goes to 26, we make $1. If it goes to 20, we make 7. Now, what's my third step here?
Right.
What's my strike price?
30.
Yes, there you go. With confidence. Okay. So I strike it, so I put a line through. Strike the strike. So I cannot, the stock can go past it, but I cannot. So how high can this, so I can only lose how much money?
3.
And how much can I make? No,
Oh, 27. 0.
the down is never unlimited. Does anyone not get what I'm doing here? If you don't stop me, I'll do it again.
When you say how much you can make, you said what?
How much can I make?
What's the max gain premium?
No. I buy a put. Ignore this for now. Based on this, how much can I make?
27.
Okay, let me do this right. If the stock goes to 20, how much do I make? 7, right?
No.
If it goes to 17, how much do I make?
10.
What if it goes to 0?
7.
That's my max gain because it can't go below 0. So let me show you different. Same 4 rules. Buy 1, XYX, October 50, call at 4. So just go through the steps. What's my break even?
54.
Good. Am I bullish or bearish?
Bull.
Is everyone on board with this so far?
Why is it bullish? It's called.
Okay. Now, what's my third step?
Strike is 50.
Yep. Okay. See, I don't do T-charts. I hate them. So now, if I do this and I don't want to look at this problem anymore. Everything I want is on this thing. So anything above 54 is a gain. Do we agree?
Correct.
Anything below 54 is a loss. Do we agree?
Correct.
How much can we lose?
4.
Does everyone see how you can only lose 4 because you can't cross the strike price?
Yeah.
What about going up? How much can I make?
Limited.
Is there anything stopping me from making money on the upside?
No.
No, so I have unlimited gain potential. So what if the stock goes to 60?
Make 6.
Does anyone not get that? Does anyone need me to do that again?
What does the P&L stand for?
Profit and loss. We're actually doing it when I ask you questions. That's right. So that's what I'm saying. That's why I want to hear questions. Because if it goes, so who asked that question? Put your hand up. Okay, good. So if it goes to 56, because it's a small thing because I have the white on. If it goes to 56, do I make money or lose money? You, only you.
If you go to 56, you make money.
How much?
$2.
Yeah, it's easy, right? So the profit and loss is just us playing the game of where it goes. So what if the stock went to $18.42? How much would I lose?
$4.
Yup. Because it can't. Once you cross the strike price, I don't care anymore. Whatever I made or lost at the strike prices, that's where it ends. Does that make sense, everyone? Let me do one more.
See the last part again?
What?
See the last part again, please?
Okay, yeah, sure. So if the stock goes to like 30, so you walk me through this. So if it goes to 30, I'm losing. Do we agree I'm losing money because it went down? Whoever asked that question, I need the answer on that.
Yes.
He said yes.
Okay. So if I go down, where do I stop counting? At 50. So how much can I lose? 4. Do we agree?
Yeah.
This doesn't matter. Because now you think about why. What happens if the stock goes to 30? Are you going to exercise this call or buy the stock at 30? And you let this go, you lose $4. So what? It's literally my life with options. I'm so used to losing money on them, I don't even freak out anymore. Had it. Okay. 113. Just tell me the break even. That's all they want. That's really what they want to know. I can make it bigger. Oh, of course, when I do that, it just disappeared.
There you go.
I mean, I got to find it again.
We're doing 113.
113.
There you go. All I want is break even.
B.
Does everyone? What is it? Is it A, B, C, or D?
Oh,
Oh, no, that's right. Let's not rush it. Sorry. No, I know the answer. You know, so I know it. So it's like I don't know what the proper time is.
$47.50, but I don't know if it's sold or bought.
Well, all I wanted is to break even. I'll explain that in a second.
Oh,
So do we agree that the break even is $47.50?
Yeah.
Okay, so now if you buy a put, what do you have the right to do?
You buy a put, right to sell, yeah.
So what if you sell a put?
Then you have the right to buy.
Well, you don't have the right. You have the obligation to buy. So the answer is D. D is in David.
Oh,
Because you're
okay.
buying the stock at 47.
If you don't repeat that, please.
No. Okay. So if you buy a put, do you have the chart written down?
Yeah.
If you buy a put, what do you have the right to do? So what does the seller of a put have to do? They have to buy it from them, right?
So that's why it's bought.
Yes. That's why I bought the stock at 47.50. You okay with that?
Because if you're doing
And it's 47.50 is a break even. So the IRS uses the break even. That's not for this test. I just wanted you to see that's what they look like. Okay.
What test is this for?
7.
What?
What test
This is for the
this
7. So what I'm saying is that, but they could, they're not going to, they might say, listen, they could say, what do you do if you get exercised? They're not going to say the cost basis part, but they'll say, oh, if you exercise a put, what are you doing? You're buying the stock. We agree on that?
Yeah.
Okay. Now do number 112.
B.
B.
We're bullish, right? Good. Okay. Did we ever talk about opening? Yeah, we did talk about opening versus closing, I think quickly. Opening is when you're creating a position. Closing, well, I'm going to talk while I'm doing this. Closing means you're getting rid of a position. Okay? So if you have an opening buy, that's followed by a closing sale. Because if you buy a stock, an option for the first time, you're going to get rid of it by closing. And when you sell an option for the first time, that's an opening sale, which will be followed by a closing buy. And writer, since you're writing or shorting, that always means opening sale. So this one is not hard, it's just worded horribly. Number 46. So if we shorted it for the first time, that's an opening sale. And then cover means get rid of also. So cover the option means buy it back, which is a closing purchase. The answer is C.
Can you
So
explain that
right.
one more time?
What?
Can you explain that one more time?
Sure. So when you see the word writer, what does that mean? That means you're shorting, right?
Yes.
That means it's an opening sale. Writer always means opening sale. Always. Always. Never not. Okay. Then buy, and then, so if you have an opening sale, what does it have to be followed by?
Closing.
Closing purchase. Okay. I have another one for you on my other
So what's
test.
the answer, C?
The answer is C is in Charlie. This one we haven't started talking about yet, but I want to see if you guys can do it first. Actually, we did do it a little bit. Do number 89. I'm right here.
We got it.
You good?
Yes.
What do you think?
Plus
A.
C.
So let's go through. I'm going to work through it, and then you're going to tell me what the answer is. Okay, so you have a 30 call, and the premium is 7. We agree on that, right? Where's the stock trading?
35.
Okay, so how much in the money is it?
5.
So that's intrinsic. So it has to be one of these two there. We all agree on that?
Yeah.
Okay, and how much extra did you pay?
7.
No. It's worth 5. How much extra did you pay? You paid 7. How much extra did you pay?
2.
Time value 2. So premium is intrinsic plus time value. So to get a time value, it's premium minus intrinsic or whatever. So these two always have to add up to the premium. It's always intrinsic or in the money plus time value. They both have to add up to 7. Now there could be a 0. That's why there's no negatives. Okay. If the stock was trading at 25, the entire premium is time value.
Yeah.
If the stock was trading at 37, the entire premium would be intrinsic.
Okay, so what answer again? B. Okay, can you repeat that?
I don't understand how the time value came up to 2.
B.
Okay. So how do you know what? So what's the premium?
It's 7.
Okay. So we know that premium is intrinsic plus time value. Can we know that?
Yes.
So what's the intrinsic value?
The intrinsic value is 5. 35.
Oh, the
Okay.
top.
So if it's 5, intrinsic value is 5, and the premium is 7, what's the difference?
Oh, 2. Okay.
Right. That makes sense?
So 5 is the
Yes.
5 is the intrinsic or in the money, and the premium is 7. So you paid $2 more than the value, because the value is what it's worth, and it's the time value is what you spend over that number.
It's B.
Yeah.
The answer is B as in boy. Are you okay with that? Okay. I'm just making sure everyone's okay with it. Okay. I think I got one or two more good. I have a good one for you that looks harder than it is. It's not that bad.
Question.
This one. Okay. Do we have an answer?
Yes.
Do we think it's D as in David?
Yes.
Oh, yeah. Yeah.
Yes.
You're right.
Okay. Now, so when I sell remember, if I sell a call, max loss is unlimited, max gain is premium, right?
Right.
Okay. That's literally, that's D as in David. It's just written really complicated.
Yes. Yeah, go.
So, okay, so go to your chart. Do you have your chart? When you sell a call, what's your max gain?
Premium.
Okay, how much did we sell how much did we get by selling these options?
5,000.
Right, $5,000. So there's the profit. So it's 5 or 500 times 10 is $5,000. And what's your max loss when you sell a call? Unlimited, and there it is. We okay with that? The wording may suck, but you can understand it. Okay. This is what I want to talk about too, because you might get a question on this. Do you know what an index option is? An index option is an option on the actual index, like the S&P 500, or the Dow, or the Wilshire, whatever it is. You're literally betting on it. You're not looking to buy or sell stock or anything. That's not what's going to happen. You are betting on the direction of the market. So if you think the market's going up, you buy calls. If you think the market's going down, you buy puts. It's that simple, okay? So the only difference here is that it settles in cash, not same day, not like that. It means it settles in cash. When you exercise an index option, you're going to receive money. Or if you sold it, you're going to have to pay money. You're not getting shares. Remember that. And they're going to try to trick you. So if I buy an XPX 4,000 call, doesn't matter the premium, and it closes at 40.05, how much in the money is it? Do you all see that it's $5 in the money? So you will receive 5 times 100. So you've received $500. If it closes at 40.10, it's $10 in the money. You're going to receive 10 times 100, which is 1,000. That's all it is. And the buyer gets it and the seller has to pay it. Does that make sense? So the answer here for this one, just so you understand, it's the in the money amount, which is literally D as in David. You're not getting the dollar value of the index. You're not getting $40,000, okay, or $400,000. You're getting the difference between this and this, which is this. Difference between the index closing price, which is that, and the exercise or straight price, which is that. Do you want me to do that again or no?
Yeah, please.
Listen, everybody just ask him. Why not? We're talking too much in this chat. That's
Okay. Do you see that this is the straight price? I'm buying a call. I want it to go where? Good. And every point it moves up above 4,000, if I exercise, I will make $100. So how many points above $100 is it? I mean, above 4,000 is it? Do you agree that it's $10 above 10 points above 4,000?
Yes.
So I will receive 10 times 100. I will receive $1,000. If I did a put, like literally, there's no stock changing. It's literally betting on a direction. If the stock closes if the index closes at 39.90, how many points in the money is it right now?
10.
So you will receive $10 times 100. You will receive $1,000. Does that make sense?
Yes.
Did I still lose you on that one? It's awfully quiet.
no, you're good.
Okay, good. Okay. So that's why they say you will receive the in-money amount. And that's why I'm going to go back to this. Okay. That's why they say you will receive the difference between the index closing price and the exercise price. Exercise means strike price, by the way.
And you said index money is in the money?
It's the in the money amount, right? But you get cash. Don't get fooled by, oh, you get stock in the index. No, you don't. You don't get any stock. You literally get the intrinsic value. That's it. Now, that doesn't mean that's your profit or loss, but that is what you're getting.
When you say on the exercise, something was another word.
Exercise price and strike price mean the same thing. Okay? Okay. So now, if I have a put, I do have the other questions I want to hit you with before we eat lunch. But did anyone have an answer?
C,
So this, what?
is it D?
So remember, in the money has nothing to do with us. In the money and intrinsic mean the same thing. So if you buy it doesn't matter buy or sell, 50 put. Anything below the strike price is in the money. Anything above the strike price is out of them. In the money, out of them. Okay? So the answer is, if this was a call, anything below it, right? So if this was a call, it'll be B. Anything below it is out of the money. Anything above it is in the money. In the money, out of them. So right, if this is a call, if this is a question on calls, B would be the answer. Since it's a put, A is the answer. Okay. Now that we've done that stuff, I want to do a couple of bid offer questions. I don't think we did these. I want to make sure this is what you'll see on the exam. Can we get this? Remember, it's not an option question. You got to change your hat a little bit into the whole buy, limit, sell, stop stuff. So I have a customer who wants to buy 100 shares at 20, which is below the inside market. What order will we place?
Sell some? If it's below the market? Buy stock order? If you want it above the market, you would buy?
Yeah, but no. So do you remember? Maybe talk about it a little bit. Sell limits and buy stops are above. Buy limits and sell stops are below. So if I want to buy stock, I can safely say I don't want to do a sell order, right? So where do buy stops get placed?
Downside.
That's above, right? So where do they want to buy it?
20%.
So it's going to be a buy limit order at 20. So one little hint, you can probably get yourself down to 50-50. It'll hardly ever be any of these things unless they specifically say, I want to do a fill or kill or something like that. They'll tell you. A buy limit is literally saying, I want to buy the stock, but I don't want to pay over a price. So that's this. I want to buy 100 shares, but not pay more than 20. That is the long version of this. A buy limit order at 20. Because look, the market is 21.25 by 21.50.
That's great. I'm sorry, I didn't interrupt you. Go ahead.
What?
I didn't mean to interrupt you. Go ahead.
No. Go ahead, ask.
No, explain that very well.
Okay.
So in reference, what would be the stop order on that?
If I did a stop, If I did a buy stop, it'd be up here, or a sell stop, it'd be down here. Right? So a buy stop would be like if I'm short, I would be at like 22.50 or something like that. Buy stop 22.50, or a sell stop at 20. But it'd be a sell stop at 20. They want a buy stop. So think of it this way: if we know slobs over bliss, what's the only buy thing that you can do that's under the price? So knowing slobs over bliss, slobs, SLBS are on top, and BLSS are on bottom. Okay. Now, these are below, correct?
Right.
So what are these two orders called? What does BL stand for?
Buy limit.
And what's the SS stand for? Sell stop, right? So if I say I want to buy stock below the price, what's the only one of these two that's a buy? By limit has to be an order by limit. If I said, oh, I want to sell it below the price, what's the only one it could be?
Sell stop.
Right. Does that make sense what I'm saying?
Yeah, it's that down.
Okay.
Can you explain that one more time? Sorry.
So if it's below the market and I want to buy it, what's the only one I can do? What's the only buy order that's below the market? By limit?
And I guess the way I'm looking at it is because $20 is below the 21,
Yes.
21.50.
Yes.
Anything under that range just goes. I've only those
So
two
anything
choices.
under 21.25 has to be one of these two things, right?
Okay.
Do you understand what I'm saying? So if it's below the market, it has to be one of these two. Did they say buy or sell?
Buy.
So it has to be the buy limit.
So you were saying if it was like 22.50 or what have you, then it would be a buy stop.
Yes. 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 Or if they said sell, it'd have to be a sell limit. Okay. Look at number 28. Now I'm going to make it two questions. First thing I'm going to do is I'm going to block something out.